So you want to get into investing. Maybe you've already started investing but found yourself going down the wrong path. Maybe you've watched my videos for a while but you just never got going. Or maybe you've got some savings and you want to start getting a good return on those savings. Or maybe you haven't got any savings at all. And the truth is, it doesn't matter how much money you have. It is never too late to start investing. But when you begin researching what to invest into, you get hit with this noise.
Hyliant is a very good company. In fact, I think it's a great company.
Don't forget to grab up to $250 worth of free Bitcoin right here.
This is it. We are going all in, baby.
So what should you invest into? Stocks, bonds, options, real estate maybe? What about crypto or NFTs? Isn't that how all those rich YouTubers with private jets made a lot of money? And what if you invest in the wrong thing? What if you invest at the wrong time? What if you lose all of your money? What if you have to go back to square one? Well, you are in the right place because this video is all about how to invest for beginners. We're quickly going to go through why you should invest. Then I'll talk about how to invest in stocks and shares. Then I'll tell you about some very common mistakes to avoid. And the last bit will be about supercharging your investing strategy. Timestamps are below if you want to jump around. Now, first, why you should invest. A lot of people have savings sitting in some bank account receiving 0.0% in interest. Over time, inflation means that the real value of your money is going down. Today, $20,000 can buy you a car, but in 40 or 50 years when you retire, maybe that $20,000 will buy you a cup of coffee. I'm exaggerating slightly, but inflation means that prices go up every year, and so you need money to grow faster than inflation so that it doesn't become worth less. When you invest money, there are only two ways that your money can grow. In both cases, you have to buy something first. You have to buy the investment. And that investment can either make you money every month or the value of that investment grows over time. And sometimes you get both. So if you buy a rental property, for example, then the money that you put into buying that house earns you rent. And over time, the value of that house goes up. So whenever you come to sell that house, the value of your investment will have gone up as well. But most people don't have a few $100,000 lying around to buy a rental property, right? And another $100,000 to pay all the fees and taxes and to carry all of that risk, to have all of your savings tied up in this one house. There are a lot of different things that you can invest your money into. Stocks, funds, bonds, options, futures. If you want to know more, I go through each of these in a lot of detail in my new course called The Investor Playbook. It's a course that teaches you all about the analysis and the strategy of investing. There are lessons on qualitative analysis, on quantitative analysis, reading financial statements, building valuation models, investing principles, and a whole lot more. And there are live sessions every week. If you want to sign up and take my course, the link is in the description and in the pinned comment. So for most people, the simplest, most rewarding, and most effective way to invest as a beginner is investing in stocks and shares. Most of the big companies in the world are public companies, and that means that you can go out and buy shares of those companies on the stock market. You become a part owner. You own a little bit of that company. You do that by opening a broker account. There are lots and lots and lots of good brokers out there. You can go and use any of them. Some are better than others. Some have better fees than others. If you want to know what brokers I use, I have some links in the description as well. Using these investing apps, brokers, the same thing, is very easy. You deposit money into them, just follow the instructions, and then you can go and search the stocks or funds that you want to invest in, press a couple of buttons, and you're done. And when you invest in a company or a fund, you only make money by the value of those shares that you've bought going up. That's the only way that you can make money investing in the stock market. So if you buy shares for $100, and a few years later, those shares are worth $180 each. If you sell those shares, you've made $80 profit per share or an 80% return on your investment. Sometimes companies also pay dividends, but dividends are not really an income, at least not a separate income from the value of the shares going up, because when a company pays you a dividend, that dividend comes straight from the company's bank account. And the moment that that dividend is paid, the value of the shares of that company goes down by the amount of the dividend because that company no longer has that cash on their balance sheet. And to make it worse, in most countries, when you receive dividends, you also have to pay tax on them. So when a company pays you a dividend, they are just forcing you to take some of that share price growth early and potentially have to pay tax on it. But anyway, how do you pick the right companies? How do you pick the company whose share price will go up from $100 to $180 instead of picking the one where the share price falls from $100 down to $20 instead? Well, the truth is, it's complicated. Even the professionals, the investors who work on Wall Street, find it hard. This chart shows the percentage of large cap investment funds who underperform the stock market average in any single year. These are the most common investment funds that most people invest in. And you can see that most years, 60 to 70% of investment managers lose to the stock market in that year. When you look over a longer period, over 93% of actively managed funds have lost to the S&P 500 in the 20 years to the end of 2023. And the best thing is that if you are new to investing, you don't have to try and pick your own stocks. You don't have to try to beat the stock market. You can just invest in the S&P 500 that beats almost every investment manager. Or you can invest in the total US stock market index, which also includes the smaller companies. Or you can invest in the total world stock market index, which includes all the companies in different markets around the world. And you can do it by just investing in an index fund. When you invest in an index fund, that fund goes and buys all of those companies in the index weighted by their relative size on your behalf. You don't have to do anything. And whatever the stock market performance is, that is what your performance will be when you are invested in that index fund. So if you put in $100 into the S&P 500 today, 7.1%, so $7.10 of your money will go into Apple stock. Another $6.86 will go into Nvidia. $6.29 will go into Microsoft, and so on and so on and so on. And the smaller the company, the less money goes into it. So these smallest companies in the S&P 500, only 1 cent out of your $100 would go into each of these at the bottom. Over time, the share price of some companies will go up, and the share price of some others will go down. And the index fund will constantly adjust the distribution of your money by buying more of some of those companies and selling some of the others to ensure that the distribution continues to be consistent. Historically, the S&P 500 has returned over 10% per year on average since the index started in 1957. But it's not a straight line up. Sometimes the stock market crashes, like this crash in 2000 called the dot-com crash, or the financial crash in 2008. And when that happens, you can lose 50% or 60% of your investment. This does happen. And sometimes, like the 1970s, the stock market can just go sideways for 10 years or 20 years. But the beauty of investing in the stock market index long term is that it doesn't really matter if now, specifically, is a good or a bad time for investing. Because the truth is, nobody knows if now is a good or a bad time, even if they say they do. If you invest consistently every month, then you'll be investing at the worst possible time to invest in the stock market, and you will also be investing at the best possible time. And those will even out. You might invest some money just before a massive crash, and the value of that money will go down. But then you will also invest some money at the very bottom of the stock market after the crash has happened, before the stock market goes and rebounds and goes up 200% or whatever. The reason that the stock market goes up over time is not luck. It's not some kind of a casino. It's not a gamble. The reason that the stock market goes up overall is because it represents the sum of the value of human productivity. People keep inventing things, making things better, launching new products, better services. And when you invest in the total stock market, the value of your investment goes up every time that the value of that productivity goes up. And if you want to start investing, I want to share some common mistakes that you probably want to avoid. When you watch YouTube or browse social media, you will see all kinds of irrelevant noise. People telling you that you should go and buy crypto or NFTs or invest in some other junk. Those people will tell you that you can get rich quick. And there will be a huge community of people in the comments who will reiterate and tell you the same thing. But the truth is, there is pretty much 100% chance, almost a guarantee, that you will end up losing all of your money, or at the very least a lot of your money, if you follow one of those paths. The fastest way to lose your money is to throw your money at things that promise you high returns in short amounts of time. The next common mistake I see a lot of people making in investing is investing in things that they don't understand well enough. If you are a beginner investor, you should steer clear of things like options on futures, and CFDs, and everything else like that. These are all complex instruments. They are mathematically relatively complex, not very straightforward. They can sometimes be difficult for professionals to properly understand. Now, I studied maths at Oxford. I worked for a bunch of banks in London and New York, and I can tell you that some of these instruments sometimes confuse me from time to time. So if you're new to investing, or relatively new to investing, I would strongly urge you not to play with fire and only invest in things that you genuinely understand well. It's very easy to get burned. And then there's investing in individual stocks. I already showed you the data about how many active investors lose to the stock market, but you probably already knew that. I'm guessing I'm not the first person to tell you this, but I know at the same time that a large number of you watching will go and invest in individual stocks anyway, because that's how we all think. It doesn't matter what I say. You'll go and invest in Tesla or Apple or whatever it is that's popular anyway. If you do that, if you want to understand how company valuations work, how stock analysis works, what the actual difference between levered and unlevered free cash flow is, go and check out my course in the description. That's what it is all about. But if you don't feel like you know the ins and outs of how it works, if you feel it's too complicated, I would again say that maybe investing in individual stocks is not a good idea, because I have seen a lot of people lose a lot of money doing it. Which brings us nicely to the bit about supercharging your investing. As you get more experience with investing, two things are likely to happen. First, you will build a much deeper understanding of how investing works, and that may open up new opportunities for you that are not suitable, not really available for beginners. Maybe you will choose to invest in private companies, or options, or something else.
It's all a fugazi. You know what a fugazi is?
But also, if you're doing the right thing and investing money consistently, then your portfolio should also be growing. And the beauty there is that as your portfolio grows, you will be able to unlock new levels in investing. Investing in property can be very interesting. A lot more interesting when you have a lot of money than scraping together just enough cash to buy, one rental property and have all of your eggs sitting in one basket. Or you can invest in starting up a business or buy an existing business. And having started up a few different businesses over time, I can tell you that having a big financial cushion makes a huge amount of difference. It's not for everyone, but if you do want to try and make a higher return than the 10% that the stock market gives you on average, and you don't choose to go for one of the scams that offers you 1 gazillion% return in 3 months, investing in your business is the way to do it. It's pretty much the only way to do it. It's a high risk, high reward sort of investment. If your business succeeds, the payoff can be mind-blowing. If you want to get the highest return possible on your money, the one place that you can get it is by investing in your own business. But there is a very big if, because many businesses do not succeed. Most fail. Many startups go out of business before they launch their product or service. And a very common reason why is because they run out of money. Sometimes the business just sucks or is not very good at what they do, etc. But oftentimes the investors just run out of cash. So if you ever do want to go down that path in the future, it's a good idea to start investing early. Even if you don't, the sooner that you start investing, the sooner you can have money to make other important life choices, like choosing when you want to retire, or choosing to live where you want to live, as opposed to where you have to live for work. Money is not everything in life, but it sure solves a lot of problems, and the way that you can grow your money is by investing. If you choose to sign up for my course, I will see you in the live sessions. See you later.